So hello and good afternoon. I welcome you to today's trading spotlight webinar. It's Wednesday, the 27th of April, 2022. And together with Admirals, we want to dig deeper into a very important topic, in fact, when it comes to trading, especially in my case, especially in a case of short-term trading. We want to dig deeper into the topic of volatility, how to gauge it, and also how to use it in your trading most effective way, at least for me. I will show you some ways how to use the standard indicator, the average true range in your trading, an indicator which I think was introduced to trading participants, traders in the 1970s, if I'm not mistaken, from Wilder. I'm not really sure because this guy introduced many trading indicators, if it was in the late 70s or in the early 1980s. But it doesn't really matter. It's a very great tool, especially for discretionary traders, in terms not just to measure how far a market can potentially run, even though it can run further, as we've seen yesterday. We will see this given yesterday's volatility event here, but also can be used to see whether a stop in your trading is too tight, or let's put it differently, if the stop you placed is placed in the so-called noise of the market, and you're risking of getting flushed out of the position here, stopped out by a coincidentally move, let's say, erratic behavior, sometimes erratic market behavior, especially when it comes to the DAX. We get to see this quite often. In fact, so we have some tendency, let's say, to see trending conditions, and sometimes also strong momentum moves in a time frame, let's say between 8 a.m. till 10 a.m. UK. But then there's a drying up period, let's say, and then we wait for the US markets to open, the market opening here of Wall Street, and then we see another mainly Wall Street induced move on the up and down side. And that being said, delivers a time frame, respectively a window, in which erratic moves can be seen quite often. So in this context, I'll give you an idea of what I'm talking about and how to most effectively place your stop based on the ATR. Before we start, let me first share my screen here. I'd like to introduce, even though I think you already have heard about the broker, respectively, you've you visited the website. Oh, by the way, this is great. So this is the trading trading chat box. So this is the chat box of the webinar, where you can ask all your questions, if there are any. If there's something unclear or so, then feel free here to ask your questions in this chat box. And the broker behind these webinars, Trading Spotlight webinar series, hot topic webinars, everything here, my colleagues Paul and Marcus and I are delivering to the trading community. Everything is made possible by a broker, which is in this industry now for 20 years plus. In fact, considered, especially here in Germany, where I am located, the DAX expert. So with the probably most competitive offering, very, very competitive offering when it comes to DAX trading conditions, but also when it comes to FX trading conditions. So even though we have seen some low volatility over the last, let's say, months to years in the FX market, volatility comes back now with yields pushing higher, inflation expectations pushing higher. And there's also right now, especially, a strong trend, which you can see, for example, in Euro USD, also major pairs, major currency pairs, Euro USD, but also USD JPY. And as you will find out, Admirals has also a very competitive offering here in this space. So check out admiralmarkets.com for further information. Fully regulated broker located in over 20 offices around the globe. You will see this in an upcoming slide, in fact. And so chances are high that you will talk to someone if you have any questions, trading related questions, account related questions, whatever that might be, that you talk to someone in your native language. Before I show you the slide here with all the regulatory bodies overseeing the business from Admirals, I'd like to also motivate you to check out Admirals here for informations around the trade days. Trade on volatility, that's a perfect in fact coincidence, let's say, when it comes to today's topic. And so there's a chance of getting a cashback on your trades here, up to 3,000 euros, in fact. And I'd highly recommend checking this out, especially if you're more active in your trading, because commissions and cost of doing business, let's say, are a very, very important part, and can mainly affect your overall profitability. I'm sorry, I have a little cold, as I mentioned in the morning with Marcus. I hope this is okay. And so having or participating and profiting from such a cashback offering here in this context can make the difference of trading profitably for the month, respectively for the year, for example, if you're very active in your trading. So check out the website also here for informations around this offering. One broker, again, so it's not just that Admiral is regulated by the SISEC, the FCA in the UK, or the ASIC, but also I think since this year, last year, I'm not really sure, but by the regulatory entity in Jordan. There you have also the chance to find out what this means, what this could mean for your trading. So check out the website for further details. But our topic today is volatility. Our topic today is the average to range, and thus I'd like to introduce the ATR to you, show you how the ATR is calculated, and then how to use it in your trading. We want to also go here through the MT5 in this context and use this so that you can see how to use this on real trading examples. And I'm not kidding. So I usually don't prepare such trading examples. So what I usually do is I jump right into the action, and then I deliver you straight away what I would do in this situation without having prepared it, or what I most likely have done here in this context. I remember a trade I had in the DAX, a short trade last week, for example. So this is an example I can give you then straight away. So I have the parameters still in my mind, so I can go through this trade with you. But in addition to that, I haven't prepared anything in this regard. So I have prepared the trading, the presentation here, but I don't prepare trading examples because I think this is closer to how you face the markets in the real world. So it's I'm not really possible. Or most of trading books out there are usually looking at indicators or formations patterns in your trading from a standpoint where they say, look at this great, let's say, head and shoulder formation, or this great bullish bearish divergence, or whatever, and how it played out here. But there's also times when it doesn't play out. And that being said, shows that these optimal examples in this context, most of the time, don't make really sense to understand the concept behind this, because this is what it's all about. It's understanding the key concepts here of the indicators, and then use them in your trading in the most effective way. I will show you, this is all probably also something which is of interest here, how to calculate the ATR graphically. I think this makes most sense. We can certainly go through text here, but I think this is too academic. Let's just have a candlestick chart, and then calculate the ATR ourselves. And then I will show you how professional traders like myself here use the ATR in their trading, how to use the ATR for trading range calculations, so intraday trading calculations. So let's say the opening is, let's say, 14,000 points, and the ADR in case of the DAX, ADR is 250 points. So what you usually would expect then is the market to move within this range. So the candle will likely see a trading range of 250 points. If there is a big fundamental catalyst, certainly we could also see a move which is way bigger. But still, this gives you a first idea on what you can expect for the day. And also, if you know what kind of trader you are, and especially if you follow a clear predefined plan, you know your personal strengths, then there will be days when you just say, well, right now these criteria are not fulfilled for my trading, thus I have to skip the trading day and just see whether tomorrow offers a better opportunity. This is also trading. In addition to that, there's also the stop loss calculation. How I do that, again, this will be part of the upcoming minutes. So What's the difference between ATR and ADR? So in case of the ATR, we are talking about a trading indicator, so average true range. What this is a part of this presentation. And ADR, this is something we refer to as American depository receipt. So like, how can I make this the most effective way to explain this? Just imagine you have limited access to Chinese equity markets, but still you want to trade stock like Alibaba or JD, or what else do we have? A Billy or Alibaba, Billy, NIO, for example, electric vehicles in this context. So it's very difficult to trade these stocks because you have limited access to the Chinese equity markets here in this context, and thus as a foreigner. And here, then, for example, brokers create a market with ADRs, which market participants can trade with each other via a stock exchange. So this is a very rough way to explain this, but how you can understand ADR. So obviously, it's something completely different. But if you look this up and you don't find something on ADR, then just Google for American depository receipt. So this is usually what you will find then. But we are talking about the average true range today. So the ATR, the development of the ATR, as I already mentioned at the beginning, goes back to J. Well Wilder, who initially applied the ATR to commodity trading. Wilder is also the, let's call it, inventor of, for example, the relative strength index. He's also the inventor, I think, of the CCI, Commodity Channel Index, if I'm not mistaken. So very active in terms of trading in the 1970s, 1980s, where especially commodity markets have seen a very volatile environment, one which we are remembered to in today's commodity markets. And he was also, he was an inventor. He was someone who thought about markets. And what he realized, for example, in terms of commodity markets, was that the focus on the daily trading range wasn't really sufficient for the purpose here of measuring the market volatility. Why is that? Well, because especially you've probably read plenty of the interviews in the Market Wizard series with Jack Schwager, and there have been big losses to traders who faced so-called limit up, respectively limit down days. So that the market was priced significantly higher, and then the trading for the day is interrupted since a certain threshold is how can we say that? Is met or is hit in this context. And so especially gap prone markets, well, we have to find a so-called true trading range, because he thought that markets, or he found out that markets who are gap prone are likelier to move stronger in one or the other direction. This is not necessarily because of a huge gap usually results in a big market, but it's more because of a gap most likely results out of a big fundamental driver. And though the big fundamental driver in this context results in a very strong move on the up, respectively on the downside. So there's plenty of examples, especially in the pharmaceutical, biotech world, and so on and so forth. You probably, well, came across this around the time of COVID and the invention here of vaccines, respectively, pills, who can be used in this context, and then there's a successful phase 1 study, and they start with a phase 2 study, and then they go to the phase 3 study, still very successful. The market continues to gap higher, pushing aggressively higher. And then at the end, they find out, okay, it doesn't really work, or it's not worth our focus here in this context. And then phase 3 fails, and you see a massive backside opportunity, let's call it. And the market is gapping lower than and pushing significantly lower. So coming back to the ATR, what Wilder did was he calculated the difference between the current high of the day and the low, or not necessarily the day, depends a little on which time frame you look at. This is also true for 5-minute charts or so on and so forth, hourly charts. He also calculated the difference between the previous close and the current high, then the difference between the previous close and the current low. And Wilder then calculated the average of this true range, which included also the gap. And this is what he did over several years. And thus he found the ATR, the average true range. So as I already said, this sounds quite, let's say, academic in this context. And so I think it makes more sense here to have a look at a visual example in this context. So you have 2 candles in this case. So let's assume this is a daily candle, and you see then the market moves up here, and this is what we call S1. So S1 in this context is the difference between the current high and low of the trading day. And then what we do is here. So well, or put it, yeah. This is probably a good way to put it. So calculate the average of the true range over the desired number of periods. So it depends on how many candles you look at. What you then have is obviously market gapping up here in this context. So if you see the open within the range here of the day before, so in case of a candle, you can see that here. You just calculate here the high and the low of the current day you're looking at. In case of the market gapping higher, so here you can see the closing price is lower than the opening price. So you see the market gapping above that. What you do is you look here at the closing price, and then at the high, you're calculating the high of the day. In case of a gap lower, as you can see here, closing price, and then you have here, well, this is probably bad because this should be a red candle in this case, but then you say, okay, I have the low of the day, and then I look at the closing price in this context. Long thing short, this is how you then how you calculate the average true range. So what you do is you say, for example, I'm looking here, default is in the MT5, for example. If you download here the platform on the website from Admirals, you will find out that the default parameter is 14. So you look at 14 candles, and then you say, okay, well, obviously you have here the high and the high of the previous day, respectively low and low of the days you're referring to. You calculate this for 14 candles ongoing, and then you divide it by 14, and you get a average. And this is how you calculate the average true range. So not something which is extremely complicated or so, but which is highly valuable when it comes to your trading. And this is exactly what we want to dig deeper into now. So I really don't want to waste too much time on the calculation of the ATR. You can easily look this up in many trading books and Google, and there's plenty of input there. But what you not necessarily find there is how to use the ATR then in your trading. And this is what we now want to look at. So I want to show you how I, in my case, use the ATR in my trading. So first of all, it's to, let's say, forecast or predict the trading range of the day. It's not really true. It's more kind of, it's not really a prediction, because I know there's plenty of stuff which could happen. So for example, let's take the current situation. Yesterday, I was talking to a client, and he was asking, hey, what do you think right now? Well, next week we have the Fed, and we have a potential 50 basis point rate hike, and then probably they communicate even further restrictive steps in the near future. And so what do you think about how the market will react to this, what the S&P will do, what the DAX will do? And I said, well, I could imagine that we're not getting to see lots of action in this case, because the market is already showing what it expects in terms of the Fed. So if you look at the Fed Watch tool, you can clearly see here that the market is expecting for the next rate decisions, not just in May, but also in June, July, and then September. It expects 50 basis points hike each. In fact, in June, the market is already expecting a 75 basis points rate hike. So very, very, very restrictive. And so I said, since the market is expecting that, I don't really see why the markets should see stronger moves on the up and downside. It took something like 2 hours. And look at the chart. Obviously, I was completely wrong in this context, because I hadn't on my agenda that there was is it really a further escalation of the war in the Ukraine? I'm not really sure about this, but you probably, or at least this is what I would say is the main driver for the bearishness right now. It's because Poland and also Bulgaria said we don't pay Russian gas in rubles, and thus finance the war here of Russia. And since they were, so there was a notification in advance already last month. That was what could have been expected, but as obviously can be seen right now, no one really could have seen that coming. Also, the EU in this case, looking now at this decision, which is for me at least not a big surprise, but okay, well, the market obviously was surprised, and then we see the strong move in this case on the downside. So in this case, the market moved more than one ATR, but still, that's a good way to do that, especially if there's no external news, let's say, let's put it that way, and the market is, let's call it, calm to some extent. Because what you can expect is, in fact, that especially institutional players, what they do if they have to build a portfolio, if they have to, let's say, buy stocks of a certain name or something, what they do is usually they say, okay, I buy because I think this is cheap compared to what I expect the market to trade at in, let's say, 12 months from now. But if the market moved strongly in one direction, what you usually get to see then is an exhaustion of this move in this direction. This is also true for selling, but let's assume we're looking at a market which is going higher. And so that being said, results in a not so attractive risk reward, which means that institutional players who push the market higher are then stepping down, saying, well, I'm not buying here anymore. And how do they calculate what has moved a lot? Well, they look at this in relation to the ATR, for example. So we could now, when looking at stocks, for example, also go in further depth. You could say, okay, how could I find out what was the average price market participants paid here for stock XYZ for today? And then you look at the volume weighted average price, for example. You see that the market moved 1 ATR, 1.5 ATR away here from the volume weighted average. And that being said, volume weighted average price in this case, that being said, means that if you're now buying 1 ATR higher than the market on average bought, you're making, put this in quotation marks, but you're making a bad trade, because what you usually get as an execution only trader is your P&L slash your bonus especially is calculated based on how well you executed your trades in relation to the market. And how does a manager, a senior trader, investment bank, however, calculates this? Roughly speaking, they look at how they executed in relation to the volume weighted average price. And so professional traders, institutional traders, execution traders in this context, what they usually do is then say, well, the ATR is a great tool to measure not just volatility in the market, but also how far the market has moved in one or the other direction, if it has moved. And that being said, delivers then an idea which says, well, the risk reward is unfavorable. The other point is the stop loss calculation. But before we look here at the stop loss calculation, 1 second, please. I have to fulfill my sheet here in terms of which stocks I plan to trade today, which is very interesting because I'm not really sure if I trade today. So probably I will see how the market behaves after yesterday. Probably I'm going for a bounce trade. After markets yesterday, we had Microsoft with earnings, strong earnings, but the average daily trading volume is not that high. So on average, there's 34 million shares being traded. Right now, there was just 1.5 million trades shares being traded in the pre-market. And this is Well, what you want to see after earnings, especially if institutional players are becoming, let's say, nervous or something, what you want to see then is more volume being traded. If this is not the case, then probably the stock is not as hot as you may have guessed earlier in the day. Another play is probably Tesla after the sell-off yesterday. And very strong earnings last week. So I think fundamentally, yesterday's move is not justified, not one bit. So I could really imagine to see a bounce back above 900. If this doesn't happen, on the other hand, well, then I think it could get quite ugly, let's say. But as of now, I'm still positive, not just for Tesla in this case, but also for the overall market. But still, there's a chance to take the Fed to the battlefield and then see whether they will deliver. The Fed put are still willing to deliver the Fed put despite the shoot higher in inflation in this context, especially after probably a little panic sellout down to 4,000 points or so. But coming back to the stop loss calculation, so what I usually try to ask myself. So there's some very effective ways to place your stop, but still, it could be that there's something you see which is not really there. Put it that way. So like a sequence of higher highs and higher lows, and then you say, well, if I trade now the break to new higher highs here, and I place the stop below the recent relative low in this case, which makes sense from a price action perspective in this case. So what you then should consider is what's the overall volatility in the market saying. So probably the stop is too tight. It's not that often, but sometimes there's a let's call it strong compression before there is a huge explosion on the respectively on the downside. And seeing this compression happening means that the volatility is drawing up in this case, and that, let's say, price action wise, sensible stops might be too tight. And so what I do is, before I place the stop, I have a look at the ATR here on the time frame I plan to trade, and then I say, well, is the stop I place here now within the average trading range, the average true range, or is it outside of this range? So let's assume the average range says something like 20 points, and you place your stop of, let's say, 15 points, because price action wise, this is what the chart tells you. It's too tight, because now you're likely to get flushed out of the trades, because your stop is too tight in relation to the overall market volatility you get to see. On the other hand, if the ATR is 20 and your stop price action wise, market is making new highs, let's say, in this scenario, or new lows, and this is where you have your stop being placed, this could then, on the other one, this could, respectively, this usually means that if you're now getting stopped, the market is making new highs or making new lows, and it was out of the ATR in this context, then this here in this context is a true stop out. So you have no reason to still formulate a bullish, respectively, a bearish trade hypothesis in this case. And yes, exactly. This is now what we want to do. I think this makes most sense in this context. So Baron has a question on will there be a graphic example here, and so what I prepared now. Let me just go through the slides here. What you see here, the forecasting the trading range, you have lots of text, and also in terms of the stop loss calculation. We will go through this, but I first of all will show you how to do this in the real trading world based on a real chart example we have here. So in this case, what we have is the DAX here on a daily chart. And so let's take yesterday, or let's take this day. Let's take today. Let's take today. Why not? So I will work here with a Word document. Let me just open this. So let me just get this over here. And then we say DAX daily ATR 14 equals. And then we make this larger. So, and what we do is we now have a look at the ATR. You'll find the ATR by simply clicking here on Insert Indicators and then on Oscillators. And right here, the first one is the average true range. So let's have a look now at today. So where is the ATR? So where did the ATR close yesterday? To get a better idea. So in this case, as you can see here, so the value of the ATR is the value of the ATR here is 292.4. So round about 290 points. So this is what you should expect given recent volatility over the last 40 trading days, the market to push on the upside, respectively on the downside, the trading range on the day. So it's a 290 points ATR we have. And so what I do next is I look at where's the opening price today. So in this case, the opening print was 13,844. So that was where we started the trading. It depends a little on whether that makes sense to look at this price, because now we have a 24/7 trading market. So or 24/5, I'm sorry. And sometimes I think it makes more sense in case of the DAX to have a look here at the price we see at 8 a.m. in this case, because this is German time. This is usually the time when most of the volume pours into the market, with institutionals coming in. And here, that being said, I look at this price. So, and here we have the opening print at 13,070.47. So that being said, delivers the next point, opening price, 13,747. And then what you do, you can round this up. You can easily calculate and look on the up, respectively on the downside. You give the market, to some extent, 300 points on the upside, right from the opening price, but respectively 300 points on the downside. And this is usually what you should expect. I mean, this changes. Like today, for example, now you say, okay, we traded as low as this is 13,560. Is it correct? 560 low. Yeah, 560 was the low of the day. So if you now, for example, let's assume you for whatever reason you entered the market here in this area. Let's say you were just seeing this sharp drop right on the open, and you then say, well, we didn't push. Let's here look at yesterday. We didn't push significantly below the lows from yesterday, so that was the closing price. But instead, sharply reversed after flushing lower and then seeing a quick rebid and closing above that price. So it could result in you saying, well, I entered the market now, and in this case of, let's say, 13,654. So this is the opening print of this 5-minute chart you're looking at here. So you see, this is a 5-minute chart. Now you calculated, in this case, you calculated the ATR on a daily chart, and you enter the trade then on a lower time frame. And so trade entry in this case, you say, well, trade entry, no, is 13,000. What did we say? 750? No, 650, right? Yeah, 654. 654, this is where you enter the trade. And you have also then the low of the day, so which is usually your stop / low of the day. And then you say, well, this is here, you can already see this is a very volatile environment, even on a 5-minute time frame. You're placing your stop here at 561. So around 90 points risk in this case. And the next question is, I'm sorry, 60, is it correct? 1 second, 561, yeah, 561. So resulting in a risk here of the entry at 13,654 and the low where you place your stop at 13,561, you have a risk in this context of 39 points. And what you then say is, okay, how much can I expect the market to move higher now given the recent volatility, which we saw in this current environment. And then you say, well, the ATR is 290 points, so we add 290 to the low of the day. So it's purely theoretical, but you get an idea how to work with this and how to answer a question like, is this a favorable trade? Do I have a favorable risk reward on the trade? So you say 290 points and you add them to the high of the day. I'm sorry, to the low of the day. And then you say, okay, 90 points brings us to 651. And another 200 is projected, let's call it ATR target, is 13,561, and then plus 290 points, because this is the ATR, which brings us, as you can see, to 13,851 points. So this is the target we are looking for if we get to see a 1 ATR move from the daily lows. And now what we want to do is, I don't know whether that's played out, but I think it's close. Let's have a look here. Where's the high of the day? 840. That's not bad. That's 10 points, just 10 points. So there's a clear change in character, especially after this move to new intraday highs here in this context. So that being said, shows you this concept seems to work quite nicely here, right there, and it's really like it's projected in this very volatile environment. So usually you get a trading range of 290 points. I haven't prepared this, so I didn't really know what we get to see now, and I really had to really think about what I would tell you. But it works more often than it doesn't, at least on my personal experience. So that means that if you now see here in this context, the market moving into this area and then falling short to reach these highs, this is most likely the reason why you then take out the trade. I don't know. It's something like 810 or something. I don't really know. But what you have an idea from is how much you can expect such a sharp reversal to run from the daily lows, respectively. How much of a reversal can you expect on the downside to happen, which is also interesting. If I now had to take a bet on what do I expect for the rest of the trading day, mainly depending on what US markets will deliver us. But given the ATR, I think chances are subdued to see a significant break higher and the retest of 14,000, at least today, because we have already seen this ATR move. So probably there's a small push to new highs, and then the market is just drifting sideways out of the price action. So most likely we have seen most of the move for today. And this is it, in fact. So based on this information, now when you say, well, we have already seen one ATR move from daily lows to the daily highs, now you have to wonder, if I enter the market right now, for whatever reason, is there a high chance to get to see a strong trending market? Not necessarily without an external fundamental catalyst. That's what I would answer. So because from a mathematical standpoint, we have seen most of the trading range for today already. And I think this can be very, very helpful if you have to answer the question for yourself. Does it make sense to enter the market now with the expectation of a push back to 14,000? Could certainly happen, no question about that. We could easily also say an ATR move, which goes beyond what we've seen for the last 14 trading days. But I'd say the chances for such a move are less than 50%, which is then showing us or bringing us to like, I don't know, next step, expected value calculation, and saying, does it pay out to risk here against which level to go for at least a retest of these highs, probably a push to 14,000, or probably should I call it the day, or focus on other trading assets in this context. So this is now how you work with the ATR on a daily chart, how to calculate what to expect for the day. So now let's have a look here. Let's assume we are going long. So let's just assume that. It sounds a little ridiculous because the market is now pushing higher, but it's perfect for my example in this case. So let's say we are going long here with this candle now at 13,790. Is it 770? Yeah, 770. So this is the opening print. Whatever reason there is why we have entered doesn't really matter. What matters is how much do we risk on the trade? When are we wrong on the trade? So one thing I'd like to say right here if I wouldn't enter the trade. And the reason for that is very, very simple, because we're trading around the exponential moving average 50 in this case on a 5-minute time frame. And I don't really like to enter a trade in this environment because there's no clear advantage being seen here. And this is the reason why I don't want to enter here. I want to enter now if we see a pull in and really can hold this exponential moving average. This is probably a chance then to enter, but all in all, I'd probably take a step back. But let's assume we do that. We trade, we anticipate the break higher here. So now the question is, where do you place your stop? And what will you say? Well, I think you will say, if we break these lows here, then I don't want to be long anymore. So if I enter the trade now, let's say at 13,770, and I place my stop here at 13,745, I have a risk of 25 points. So let's assume now we have to work with another ATR. I put this in here. So you can see the ADR here is 22 points. So this is the average of the last 14 5-minute candles. So it's around 22 points. So that being said, delivers 22. Okay, great. We enter the trade at 771 or so. I'm sorry. This is not right. Let's say we have the trade entry there. So we take this out, and then we place the stop at the last relative low here, let's say. So it's not really a relative low, it's a swing low, in fact. So does it make sense? Price action wise, not really sure about that, but let's assume it makes sense. And we're using this stop. So if we place the stop at 745, so the risk is 26 points. What would you say? Is the stop too tight, or is it okay to work with such a stop? Depends. It depends on how you calculate this. So what I prefer to do is, in fact, I say, if I'm working on a lower time frame than the daily chart, where you have 290 points in this case, I prefer to multiply my ATR here with a factor, most of the time with a factor of 2, which brings us to a min stop. Let's call it multiplier is 2. That delivers min stop width of 2 times 22 means 44 points. So based on the ATR, this is the stop I should use based on the ATR. So the min stop width should be, based on the ATR, 44 points. I'm working, given the picture, which we find here in the chart, a stop, which is just 26 points below my entry price. Should we enter the trade? I'm not really sure. Probably it's better to work with a stop probably a little lower than that. Here, 734, 35. Even that is not bringing us to a stop width which is far enough away. If you say now 735, then we have 36 points risk, still below what the ATR tells us based on my multiplier. So given that, I shouldn't enter the trade with such a stop in the level I should risk against, or I should at least reduce my position size. If I say, well, that looks favorable, I have a picture because of this, check in my favor. We see, I don't know. Well, you look at the order book, let's say in the DAX future or something like that, or in the ETF on the S&P 500, the spider, and you see elevated R vol, or you see some kind of clear step up the bid, so some potential pressure building, which could see a strong drive in one or the other direction, then probably I take the trades like I don't know, momentum scalp or so, and risk against that level here. But I do this with a reduced position size, or if this is my like favored trading setup, I'm working with another stop in this case. So or working with another, let's call it reason to sell in this case. So like I'm not selling when we drop this level, but I'm selling once there's no momentum on the upside, occurring within, let's say, the next 5 minutes. So step up the bits just dries out, and then the market is just rolling over here. And US markets in this case, which I know open right around that time, are not pushing higher. But this is another reason, respectively, another trade I make here. If you trade on a 5-minute time frame, if you're going for a new daily highs in this case, you have to wonder, if I place my stop 45 points lower, do I place my stop here within the noise of the market right now? And also, given the daily ATR, remember, we have most likely already seen the high of the day around 841. Probably we get some 10, 20 points more on the upside, but this is not necessarily sad, even though US equity markets play their own game. So this is something we should also take into account. But something you could take into account then, and play with and get an idea. Does my stop make sense? Respectively, what can I expect here in terms of a projection on the upside, on the downside, when it comes to my trades? Why do I know that a long entry, or is it independent? This is independent. This is completely independent from that. It was just like for illustration purposes. So as I said, I wouldn't enter a long trade here in this environment, because we're trading around the EMA. We are not let's say seeing the DAX trading on its own right now, but depending heavily on what US equities get, will show us now. And so this is not necessarily an environment in which I want to enter. It's just for illustration purposes, how to see whether the stop is too tight or not. And yeah, so that's in fact it on these lots of lines I put together here, which well, probably a little overwhelming, but I hope that my illustration now in the chart made sense to you, and you could get something out of this. So let's sum this up. So what did we learn today? So first of all, the development of the ATR goes back to J. Well Wilder, who initially applied the ATR to commodity markets, trading the markets he traded mainly in the 1970s. Where there was lots of volatility, and there he realized that the focus on the daily trading range here is in fact not really sufficient for the purpose of measuring the market volatility, and therefore he then started to work with a new concept, something he and we today refer to as average true range, the ATR. So where he says, well, if we open within the trading range of the day before, we calculate the difference here in terms of the volatility between the current high and the current low of the candle we are looking at. If we open outside of the trading range on the upside, we calculate the closing price of the day before, the previous, and then draw a line up to the high of today's candle, respectively. If we look at this here, or at the current candle, if you look at this from the downside, you see a gap down in this context, which means that you say the closing price of the day before and then the low of the day, which is also delivering you the true range in this case. And so what professionals usually do, I hope that made sense in this context, is first of all, they try to somehow forecast, predict, like how far can a market continue to run on the up, respectively on the downside, after having seen already a move in one or the other direction, which is then helping us here to formulate trading setups which have a favorable risk reward and skip the trades where we don't face such a favorable risk reward. And we can use this to answer the question, is the stop too tight in this environment, given the current volatility we get to see here in trading instrument XYZ, whatever we are looking at. And here are all details in terms of Admirals as a broker. So if you have any questions, if you have any topics you want to see us discuss, here Paul, Marcus, and I are there for you. Shoot an email to Admirals here in this context, and let us know what is of interest for you. And fully regulated broker. So this is very, very important. I'm here in this context. That's why we have to finish this webinar with a risk disclaimer. Please read it carefully. Trading is you're facing risk if you trade the markets, especially if you trade them actively. So please read carefully the risk disclaimer. And that's it from mine. So happy trading. Watch your stops. Talk to you again next week. I think next week on Friday. And if I'm not mistaken, this is a quite cool action event because we are covering the non-farm payrolls. We won't cover them live, but we wait until the dust has settled. And then given what we got to see, we will formulate an idea on what to expect for the most active and most interesting currencies, but also equity indices, but also precious metals like gold, for example. And that's it for my end. So all the best. Happy trading. Watch your stops and see you soon. Bye-bye.